All right, future CPAs, let's get right into it. Today, we're not just studying for another test. Nope, we're basically giving you a financial superpower. We're going to crack the code that shows you how a company really makes its money, using two of the most powerful tools you'll need for the LECPA, return on equity, and of course, the legendary DuPont Analysis. Let's do this.
Okay, so let's kick things off with a classic puzzle. You're looking at two companies, right? Both are showing off a solid 20% ROE. Now, your first thought might be, hey, they're basically the same, equally successful. But are they really? I promise you, by the end of this, you'll see why that surface-level number almost never tells the whole story. So, here's our game plan for today. We'll start with the big headline numbers, the scoreboard, if you will. Then, we'll dive into why those numbers can be kind of tricky. After that, we'll give you what I call DuPont X-ray vision to see what's really going on underneath. We'll look at the different strategies companies use, level up your skills for the boards, and then wrap it all up with the ultimate study hack. This is your roadmap to totally nailing this topic.
Okay, first things first. Let's get to know the main dials on a company's dashboard. You know, the big picture metrics. These are the absolute starting point for any sharp analyst, which is exactly what you're becoming.
The first one, and probably the most famous, is return on equity, or ROE. The best way to think about it is the ultimate report card from the owner's point of view. For every single dollar they've put into the business, how much profit did the company actually make? It's laser-focused on shareholder returns, just like its close cousin, return on ordinary shareholders' funds, or ROSF.
And here's the formula you've got to burn into your brain. You take the company's net income, and you divide it by the average shareholder's equity. It's so simple, but incredibly powerful. And I guarantee you this will be a major player on your LSCPA exam. You're going to see it everywhere.
Next up, we've got return on assets, or ROA. Now, this one kind of zooms out for a wider view. Instead of just looking at what the owners put in, ROA asks a bigger question. How profitable is this company with everything it owns? We're talking cash, buildings, inventory, the whole shebang. It's a fantastic way to measure a company's operational efficiency.
And finally, there's return on capital employed, or ROCE. This is a really fundamental metric. It looks at how well a business is making profits from its entire pool of long-term money. And that means money from the owners, which is equity, and money from lenders, which is debt. It's a true test of a company's overall profitability. Okay, let's circle back to that shiny 20% ROE we started with. It's time to see how it can be a bit of a trickster. While all those scoreboard numbers are important, we're really focusing on ROE today because it's the perfect example of how one single number can hide just as much as it reveals. And understanding this is what's going to set you apart.
This quote really says it all, doesn't it? Ratios are like the check engine light in your car. They tell you, hey, something needs attention, but they don't tell you if it's just a loose gas cap or, a major engine failure. The number is just the beginning of the question. It is never the final answer.
All right, time to put on your lead apron because we are about to fire up the DuPont X-ray. This framework is a total game changer, developed almost 100 years ago, and it's your secret weapon for looking straight through that single ROE number and seeing the bones underneath. The absolute genius of the DuPont analysis is how simple it is. It takes that one ROE number and breaks it down into three fundamental pillars of how a business performs. It reveals the how. How did the company actually get that return? It turns one flat number into a whole strategic story.
And here it is, the magic formula. ROE is just a product of three things. First, you've got profit margin. That tells you how profitable they are. You multiply that by asset turnover, which measures how efficiently they're using their stuff. And finally, you multiply that by the equity multiplier, which shows how much financial risk or leverage they're taking on. So remember, profitability, efficiency, and leverage. That's the secret sauce.
So what do these three levers, profitability, efficiency, and leverage, really mean in practice? Let's use an analogy that I think will stick with you all the way to your board exams. Think of it like you're building a race car. This analogy is perfect. Your profit margin, that's your engine's horsepower. It's how much punch you get out of every sale. Your asset turnover, that's the car's aerodynamics. How sleek and efficient are you at turning your assets into pure speed? Or in this case, sales. And financial leverage? That's the turbocharger. It can give you a massive, massive boost. But if you're not careful, it can totally blow the engine.
And boom, here it is, the solution to our mystery from the beginning. Both companies hit that 20% ROE, but just look at how they got there.
Company A is like a luxury car brand running on huge profit margins. Company B, it's more like a budget supermarket relying on insane efficiency, that high asset turnover. Same ROE, totally different business models. See? X-ray vision.
Okay, so you've mastered the three-step DuPont. You are already way ahead of the curve. But for the LECPA, you want every single advantage you can get, right? So it's time to take this to the pro level with the extended 5-step version. This is how you really stand out.
Think of the extended framework like switching your X-ray to an MRI. It just gives you an even more detailed picture by breaking down that profit margin component even further. It helps you pinpoint exactly where the performance is coming from. Is it the core operations, their financing decisions, or their tax strategy?
So here are the 5 levers. We've got operating margin, which is just pure profit from the main business. We still have our friend asset turnover, our efficiency metric. Then there's interest burden, which tells us how much of that operating profit gets eaten up by debt payments. Next is financial leverage, our turbocharger. And finally, the tax retention rate, which is just how much profit is left after the government takes its slice. Altogether, they give you this incredibly detailed view of what's driving that final ROE number.
Okay, team, this is it. This is the moment. Get your phones out right now. This next slide is the one you screenshot, the one you save, the one you look at right before you walk into that exam hall. This is your ultimate study hack for making all this knowledge stick for good. It's all right here on one screen. The key metrics, what they mean, the 3-step DuPont formula, and our race car analogy to lock it all in. Remember, ROE is the owner's report card, and DuPont tells you if that grade came from raw engine power, sleek aerodynamics, or a risky turbocharger. This is your key to remembering this stuff years from now.
So we'll end with a question for you, the analyst. Now that you have this X-ray vision, which strategy do you think is more sustainable in the long run? The high-power, high-margin company or the high-speed, high-efficiency one? The truth is, there's no single right answer. But now you have the tools to make a powerful, informed argument for either side. You're not just looking at numbers anymore, you're reading strategy. Now go ace that exam.